Hi, everyone. Welcome to our webinar this afternoon with Stambaugh Ness, Money in Your Pocket, R&D Credit for A&E Firms. Our presenter today is Tom Moul. He is the Director of Strategic Tax Advisory here at Stambaugh Ness. And now I'm going to turn it over to Susan Patrick, who's also on the call this afternoon.
Thank you, Kaylee, and welcome, everyone. I'm not going to spend too much time because we have a lot of great information to pack into a very short period of time. But thank you again for joining. A couple items to recall based on our other webinars if you haven't participated before. The handout is available in the handout section, so if you do want a copy of the handout, you can go ahead and get it there. Also, if you have any questions, please feel free to put them in the questions panel. We may not have time to get to them all today, but I assure you that we will get back to you if you do put a question in there, that we will follow up after today's event and answer your question for you. So without further ado, I'm going to go ahead and turn it over to Tom. Thank you, Tom.
Thanks, Susan. Thanks, Kaylee, and welcome everyone to our webinar this afternoon. Thank you for taking a little bit of time to join us. As Kaylee and Susan said, the topic today is the Research and Development Tax Credit and how that applies for architecture and engineering firms. Just to get started, if you don't know us here at Stambaugh Ness, we've been around, this is our 100th anniversary this year. We're very proud of that. And we spent a vast majority of that time, over 60 years, working in the AE space. So it's an area that we kind of live and breathe every day. And we've really seen a lot of activity with the industry on the R&D credit over the last 2 years. And that's part of what I'm going to tell you about as to why it's grown so much in the last 2 years. As Kaylee said, I work in our Strategic Tax Advisory group, so looking for these type of opportunities to help our clients save money is what I do on a day-to-day basis. So enough about that. Let's get into the subject matter. So we'll start that. Susan, you want to handle the polling question for us?
Yeah, absolutely. So before we get started, we kind of want to get a baseline of our audience. So our polling question number one, which Kaylee will bring up now, is how much do you know about the R&D tax credit? Very little, you use it now, or you looked into it in the past and didn't use it for various reasons. So let us know where you stand pertaining to knowledge of the credit. Pretty interesting information floating in here, Tom. Kind of help give you a baseline of the audience today. Kaylee, I think you can go ahead and close the poll. But for your information, Tom, and the group, about 55% of you know very little. 26% of you currently use it, so that's awesome. And 19% have looked at it in the past but didn't use it. So that's good information for you, Tom, as you kind of roll into the tax credit.
Yeah, thank you, Susan. That is good information, and we'll certainly kind of tailor some of our comments to give you a good background on the credit. Those of you that are using it probably have experienced what the benefits are and how it can benefit you. And even for those of you who have looked at the credit in the past but didn't use it, we have some key comments today of why it might be time to take another look at that. So I'm going to break these next two slides down into two time frames, the pre-2018 and the post-2017. Many of you have probably already filed your 2017 business or personal tax returns, unless you're out there under extension. We just went through that filing deadline last week. But even if you didn't take advantage of the credit in 2017 or maybe before, all is not lost. Returns may be amended for up to 3 years from the date filed. So returns for 2015, 2016, and 2017 could all still maybe be out there holding some cash that could come back in your pocket. For the future, 2018 and beyond, I'm sure all of you are aware that we had some very sweeping tax legislation that came through in December of 2017. In essence, it was a bit of a Christmas present for most taxpayers, but I would throw out some caution on that we tell all of our clients. Everyone's going to be affected by this tax act a little bit differently. Don't really believe kind of the sweeping generalizations you may see in the media about how it will affect you. You really need to peel that back and look at your own situation. But generally, we think the Tax Act is going to be favorable. The big news is tax rates have dropped. You can see on our slide, we list out what the maximum rates were for both individuals and corporations prior to the Tax Act and what they will be post. Especially the C corporations out there got a very significant drop from 35 to 21%. And my guess is a lot of you are probably organized as pass-through entities, as corporations and partnerships and whatnot. And there's a provision in the new Tax Act under Code Section 199A that actually allows a 20% deduction of income for those folks if you qualify. And the good news was the architecture and engineering firms were specifically identified as qualifying. That's kind of beyond the scope of what we're going to talk about today. But the real news is taxes themselves will be a little bit lower. That, we believe, does not minimize, though, the importance of the R&D credit. Because remember, it is just that. It is a credit, not a deduction. Credits lower taxes dollar for dollar. So a credit earned will lower your tax. So while you may start out with less taxes to begin with, we can carve them down even further using this credit. That's not to minimize deductions and say we don't care about deductions anymore. But remember, a deduction saves you based on your tax rate. So a dollar deduction before may have saved you 39.6% or 35% taxes if you were an individual or a C corporation. And now it will save you, the new rate's 37% for individuals, 21% for corporations. So the deduction lost a little bit of its value, but the credit maintains that dollar for dollar value. And we think the credit's here to stay. Congress has been very supportive on both sides of the aisle of the credit. In fact, there's been some proposals to even enhance it, and we think the president is on board with it too. So we don't think the credit's going away anytime soon. So with that, let's jump into the mechanics of what the credit's all about. And the first thing you probably want to know is, well, what is it worth to me? Well, it's generally worth a minimum of 5 to 6.5% of something called qualified research expenditures. We're going to talk in much more detail about these QREs are, and oftentimes the credit can be even more than that for a growing firm, someone whose revenue is increasing and their corresponding labor costs are increasing. A couple of really significant things happened in December of 2015 in regards to the credit. In 2015, we had some last-minute tax legislation as well, just like we did in 2017. This tax act was called the Protecting Americans from Tax Hikes Act, and it extended a lot of tax provisions that had expired at the end of 2014. We spent 2015 in a bit of limbo, not knowing if some of the tax planning strategies we had used in the past were going to be in play for 2015 and beyond. Congress finally came through on December 18th of 2015 and passed this, as we call it, the PATH Act. And this act had some nice surprises, especially in regards to the R&D credit. One thing it did is it made the credit permanent. Prior to that, the credit was subject to expiration every 1, 2, 3 years, however long Congress had extended it for previously. The credit's been with us since 1981, but it had never been a permanent part of the tax code. And while I think there was only 1 year in that entire time period where the credit actually was not in play, people were a little hesitant to jump in, make the investment, take the time needed to calculate the credit, not knowing if it was going to be with them. This Tax Act took care of that. It is now a permanent part of the code. Obviously, Congress can always take proactive action to eliminate it. But as I said before, we're seeing proposals to even enhance the credit further, so we don't think it's going away. The bigger item, a much bigger item for most firms, was this provision regarding the alternative minimum tax. And I know you've probably all heard about the alternative minimum tax or the AMT tax. You may not have a real good grasp of it because it is quite complex and quite difficult to understand. But the fact of the matter is, over the last several years, maybe 10 to 15 years, more and more individuals and a few corporations have been subject to the AMT. The AMT is a way of calculating your tax a separate way of calculating your tax in comparison to the regular methods that you would compute on your tax return, and each taxpayer then pays the greater of the regular tax of the AMT tax. Well, where this is significant in relationship to the R&D credit is prior to 2016, you could not use the credit versus AMT. So if you were an S corporation, you were passing your credit, maybe generating a nice credit at the company level on to your stockholders. If they were subject to AMT, and my guess is many of them were, they couldn't use the credit. So why go to the effort to generate the credit? Well, the PATH Act said if your firm generates $50 million or less average gross receipts, the AMT limitation is gone. So for those of you that maybe looked at the credit before and said, I don't think it's going to help us, it may be time to take another look, because we're thinking generally just about everybody is going to be able to use the credit now beginning in 2016 and moving forward. And it's really with the 2016 returns that we saw quite an explosion in the number of credit studies being performed and credits taken. And as I'll get into some examples a little later, some very, very nice returns and some very nice results on that. So if you haven't looked, it may be time, and it may be even an opportunity to look back as far as 2016 and grab those credits and get some cash back in your pocket. A third item that was in the PATH Act pertained to startup entities. So if you are a new firm, and new firm defined as having gross receipts for 5 years or less and having average gross receipts of $5 million or less, if you're in those early stages, you maybe aren't turning a profit yet and you're not generating income taxes, this credit can be used to offset your payroll taxes. Again, a very powerful vehicle to help you save some costs, put money back in your pocket that can be funneled back in to building your new firm. If all of that doesn't work and you still aren't able to take the credit in the current year for whatever reason, you can carry back the credit for 1 year, and more importantly, you can carry it over for another 20 years. So I would venture to say that just about everyone is going to be able to utilize the credit, if not today, probably sometime in the near future. So now that we've talked about what it's worth and a little history, we'll jump into another polling question here. So Susan.
Yep, so since revenue certainly impacts the credit and what that means for your organization, can you let us know what your firm's annual revenue is? And we have some ranges here for you to kind of track that under 10 million, between 10 and 50, and over 50 million. Great. So I think most people that wanted to answer have answered. So for those of you in the group, 61% have said that they're under 10 million, 30% in the in-between, 10 and 50, and 9% over 50 million.
Okay, well great. And thanks again, Susan. Well, and that just kind of plays into what we talked about with those changes that were made in the credit. It sounds like over 90% of you are under that 50 million threshold. So the AMT is probably no longer a consideration for you. So there's a really good chance probably that you're going to be able to take advantage of the credit. For those of you that are over 50 million, no need to fret on that. Even though the AMT limitation is still in place, the Tax Cuts and Jobs Act of this past December actually had some revisions to the AMT as well, that the perception is, we'll see once we go through the 2018 filing season, that less people are going to be subject to the AMT from 2018 forward. So while if you are over 50 million, we may have another hurdle to cross to take not to take the credit, but to utilize the credit in 16 and 17. I think the door is opening up a bit for you in 2018 and going forward. So now let's talk about, you may be sitting there saying, well, that all sounds great, but how does what I do or what my firm does on a daily basis qualify for this credit? I thought the R&D credit, were for those very high-tech companies, maybe the pharmaceuticals or Apple developing the new iPhone, that's what R&D was all about. That I have to be doing something revolutionary, new to the world. Well, in the early days of the credit, that is kind of what it was all about. And if there was any silver lining to the credit not being permanent for all those years, it's that each time it was renewed, the credit was broadened a bit. And we fast forward to about 2008, and there was a landmark court case, tax court case called the Souter case, which really kind of put the icing on the cake for the AE industry, saying what we do on a daily basis qualifies for this credit. So there's a lot of key information on this slide, and it looks pretty confusing. So let me see if I can dissect that a little bit. There's the 4 bullet points you see are the key to qualifying an activity for the credit. But before we look at the bullet points, the first sentence says the development of an unfunded new or improved business component. Well, unfunded is key. To take the credit, the activity must be at risk. That's both financial risk and ownership of the research. Well, ownership of the research in the AE industry is usually not that big of a concern. That yes, while your drawings or your plans belong to your client, the intellectual knowledge that went into that belongs to you, and you technically can utilize that again in future projects. So we don't get too concerned about ownership of the research, but we do get concerned about financial risk. And there was another court case in 2014 that addressed this and said, if we have a pure time and material contract, which I think are more and more rare today, but if it is complete T&M and we are being paid for every single entry, every minute on the timesheet, we are not at risk. No matter how long it takes us to accomplish the task, no matter how many reiterations there are, starts and finishes, we're getting paid for it. That's funded. That's funded by your client. Your client might be able to consider taking the R&D credit. But in the real world, we find that those type of contracts are usually pretty few and far between. We're looking at lump sums, fixed fees, even maybe T&M to a limit or a not to exceed. Where we carry financial risk for the success of the project, it's going to be considered unfunded. And it's important to note that even if you hit a home run and come in way above, have a nice write-up on that job, you still had the risk that it wasn't going to end up that way. So those contracts are going to work for you. So that's the first step. We just, segregate your contracts into the quote-unquote funded versus unfunded. Then we look at the activity in the project. In this court case I referred to in 2008, an engineering firm took the credit. The IRS came in and said, no, you don't qualify for the credit because you're just doing what we term routine engineering, just doing your job, designing, moving on to the next project, designing, and so on. And they said, but let's look at these 4 bullet points, and we believe each one of our projects carries enough degree of uniqueness that we meet these criteria. Well, the first one's technological in nature. That one's a slam dunk. I mean, everything you do is based on the hard sciences, whether that's chemistry or physics or just flat out the science of engineering, computer science. So that one is somewhat, not under debate. That one's pretty easy to meet. The next 2 bullet points involves a process of experimentation and eliminates an uncertainty. And this is where the engineering firm in the court case said every project we do is different. There are no cookie-cutter projects where we can completely duplicate what we did before. Even if it's a similar project, we have a different set of criteria, whether that's environmental conditions, whether that's governmental regulations, whether that's the type of materials we're considering for use, the technique we're considering. We have to have in our design phase or our schematic design phase, we have to have that thought process to work through what is going to work and what is going to not. Sometimes we nail it on the first try. Sometimes we have to go back and try another technique. But that, we believe, meets those 2 bullet points. And then last, we have to have a new or improved function, performance, reliability, or quality. Again, here, a lot of times people thought, well, this rules us out. We don't have a tangible product. We're not inventing that new miracle drug. this only applies to manufacturers. Well, while that physical product certainly does qualify for the credit, it's much broader than that. New or improved function is what you're doing. You're designing something that works. So after going through that, the taxpayer won the court case. So that has really opened up the door. Now, like I said, that was 2008. It kind of verified that the credit's going to work for the industry. But we still didn't see a lot of people capturing the credit, and a lot of that goes back to what we talked about previously, the AMT limitations on taking the credit. So now we have two things in our favor. We have citations and court cases that say what we do qualifies, and we have a much more favorable tax system that allows us to benefit from the credit. So our next slide, again, I think I covered this. What is a business component? As we said, it's a product, but it can be these other things as well: processes, techniques, ways of doing things. And a couple of examples of that, are things like new or improved designs, testing alternatives, testing alternative materials or structures, development, and even internally developed software that you may use within your company. And I'll repeat, it doesn't have to be new to the industry. It only has to be new to you, to your company. It doesn't even have to be successful. If anything, the R&D credit provides a little bit of a reward for those projects that don't go quite so well. So now that we know what it's worth and what qualifies, back to this concept of the QREs. What are we trying to capture? Well, the big number here is typically going to be wages. This is simply your W-2 wages in a qualifying activity, typically the design phase. We'll talk in a minute about being able to capture that within your existing accounting or ERP system, but we're really just looking for the paychecks we're paying to the folks who not only do the design work, but those that supervise them, and even administrative people that support them. We're looking at any supplies that are consumed and destroyed in the process. Typically, this is a minor number. In our industry, obviously the manufacturer, it may be a little bit more, where they're doing prototypes and whatnot. But we do see some things like the use of 3D printers and the like. And last is something called contracted research, which in our language is our subcontractors. We're allowed to use 65% of their bill if they qualify. But here again, we have to look at that funded versus unfunded concept and see how that contract's written. So if you are a sub, you may be able to use the credit based on your work for the prime because your billing arrangement is a fixed fee, so you're the one with the risk. So we capture those expenses for the year. The credit is based on the current year's expenditures over a base period of the 3 prior years, but the good news is we take the average of the 3 prior years and we divide it by 50%. So typically we're always going to be in a position to get the credit, and you can see from that formula, if you're growing, that number grows because your base period is smaller than the current year. And that difference, your current year expenditures minus 50% of the base period times 14% is your credit. So a very simple example is if we have $1 million of qualifying costs 4 years in a row, $1 million minus 500,000 is 500,000, credit at 14%, you're talking about $70,000 of tax savings for money you've already spent. Obviously, the IRS has interest in how we came up with our number, so documentation is a key. Again, that's a place where your ERP system can play a very key role. Once we get that federal credit, often there's a little bit more for us because most states have a credit as well. So kind of in conclusion of this piece, much misunderstood. Lots of people think it doesn't apply to them, but a lot of people are really missing out on a chance to have some significant savings. So let's just look very quickly at a couple of success stories that we've seen, and these run the gamut from the very small to the very large. Our first story is a civil engineering firm we work with, a small firm. They do about $2.5 million in revenue. They design pavements, roadways, foundation, earthwork, and so on. First year they looked at the credit, $16,000 of savings. To that owner in a small company, that's pretty significant. an architectural firm that actually works very closely with that civil engineer and is of similar size, about $3 million in revenue, generated $30,000 in savings. As we move up to some larger companies, we have a contractor who does a lot of their own design build work. They're about $20 million in revenue a year. And you can see the kind of things they do there. They're looking at a credit of $96,000. So you can see how it kind of multiplies. Our next one is an engineering firm, $50 million in revenue. They're multidisciplined. They work all over the country, do a lot of highway work, bridge work, and so on. They were able to take a credit of $173,000. And then we go to the very large, a $400 million plus multidiscipline international firm. Here you're looking at a credit of $1.5 million. So it's very scalable. But I think my favorite story that I don't even have listed here was another firm, a mechanical engineer who was very skeptical. They do about $6 million in business. And the first year we walked in, we had a real, I think, challenge to convince them they qualified. But once we got them over that hump, they got an $84 million. They wish they had $84 million, but an $84,000 credit that year. And I think they're kind of sold. They're sold on this concept now. So as we said, cracking is key. We just gave a couple examples here. We work very closely with the Deltek Vision product. I'm sure some of you use that as well. But we also have experience with folks that use some of the other packages, whether that's BST or Ajira or Clearview or even QuickBooks. It's part of the key is just capturing those labor amounts. I mean, in our example here, you can see it's broken down by phases, and we're looking at the top level here by project. And then our next example shows a report that we can generate here by person. This is great documentation to utilize. If we can get our folks educated and they can do some, maybe further documentation in their comments, you're well on your way to gaining the information you need. Now, if you're saying, well, that's great going forward, we didn't know that, we didn't do it before, all is not lost. An allowable method is to do inquiry and interview with your folks. And that's typically how we get the ball rolling on most studies. So what do I do next? Well, if you're interested, if we got your attention today, we would be happy to talk to you to determine eligibility. We do a complimentary assessment. If you give us some information, we can typically give you a pretty good idea of a range of where your credit is going to fall. And we also can quote a fixed fee to perform that study. We do all of our studies based on a fixed fee, so there's no, mystery to how much this is going to pay, how much you're going to pay. You can do a cost-benefit estimate and say, yeah, that makes sense, or no, it doesn't. And certainly, if it does make sense, we can then jump into performing that study for you. So that was very quick. I'll throw it back over to you, Susan. I don't know if we have time for any questions or not. It looks like we have a couple minutes. We can try to answer those, but certainly if we didn't get to all of them, we will follow up with everyone on their questions.
Yeah, so we only had a few items in the questions panel. One just came in from Rob, and he is asking, does our fixed fee for the R&D study cover any IRS challenge?
That's a great question, and yes, actually it does. Our deliverables, when we perform the study, are the obvious, the calculation of the credit, but also a thorough documentation report that walks through all of our conclusions, projects we looked at, citations for what we're basing our conclusions on, and so on, as well as full IRS support or state support for any inquiries or examinations that would be made. And we also like to say that part of the things you're going to get from it is education as well, that we're going to educate your project managers so that they have awareness of the credit and do a better job of capturing that credit as you move forward into the future.
Great, great. And Mark has a question about the cost of the study, and he is wondering if the cost of the study is far allowable.
I I believe that it is, but I am not positive of that, but I can get an answer on that. We have another team here who does extensive amount of FAR audit work, and that's a little bit out of my area of expertise, but I can certainly get that answer for you.
Great, great. Well, there are some other questions kind of floating into the questions panel. We've run out of time for our half an hour that we've allotted for today, but as I promised at the beginning, we will certainly get back to those of you that put questions in the questions panel that we've not been able to answer. The other thing that I want to throw out to those of you that are on the call that are actually using the Deltek Vision product or Deltek products, and if you're interested in, you know, any of our help to kind of look at some of the reporting options that might help you track that, please don't hesitate to reach out to us and let us know. And if you're not on a Deltek product but are interested, you know, certainly reach out to me and let me know that as well. So we appreciate your time today and participating in the seminar today. Tom, your information is invaluable as always. And one last thing that we request is as you exit our event today, that you please fill out the survey that comes up at the end of the event. Again, thank everyone for your time today, and we'll let you get on with your day. Thank you, Tom.
Thank you.